All right, good morning. Interesting times we live in. I got the BSM going this morning, the broadening, the squeezing, the mooning. I got all sorts of moonbeams and Shibu Inu crap in the early look. With all that and all the pumpers out there, don't forget that these people haven't gone away. All the fraudsters fully loaded. That said, we're long it. Crypto being in Bitcoin, but today is one of the many month-end markups that you'll get in crypto. It's completely illegal, but they're fine for now. But we want to take advantage of that and sell into the month-end markup. So again, if you're long anything that's Bitcoin sensitive on the equity side, or as I said, on the crypto side or the Bitcoin side, they get very sensitive to cray craze if I don't differentiate between Bitcoin and crypto. Just sell some. That's it. It's just another. They're just tickers. Okay. Howard, good morning. I don't know, Howard. I'll go to we'll go from moonbeam crazy Shibu Inu eyes to buying some Clorox. How about that?
Lawrence?
Maybe you need some Clorox if that's the lifestyle you live in a van down by the river, eh?
Yeah. They have some interesting products that they debuted. Innovation is part of it. For that van down by the river, they had a new product where you spray the air. So for anyone who's still a germaphobe, that's going to sell. I think an air spray, like just I think that's going to be part of the hockey tournament hotel package.
It is. I
Um,
mean, I have friends who lived. Their parents lived in trailer parks. I got nothing against them. It's just that it's a way of life, right? Like if you're trying to it's gambling, right? That's why a lot of millennials and Gen Z say only invest what you can lose. Like it's all the stupid shit, right? For people that if you're just a student and it's your parents' money, why not roll the bones on all of it? Why don't you slap some laser eyes on and run around the trailer? But that notwithstanding, there are like real things to invest in, right? If you live in a trailer down by the river, you need some Clorox.
yes, and so that one I think we just added on the list Monday on the long side. I do have some actions today, so I'll go through them. So grocery outlet ticker GO, they reported EPS of 18 cents, 2-cent beat. Same source sales were 2.7%, but they previously outlined they're doing like an ERP implementation, kind of screwed up some things, so that cost them about 200 basis points. Gross margins were flat, but that technology thing impacted them by 130 basis points. So pretty good results. They also guided to $1.14, $1.20. Consensus is $1.14. This is the first time in a little while where they've raised guidance above where the consensus was for the out year. So they're feeling good. I think in this stock I have not had a great makes it tick, but I think this could be part of it. So that they just announced this acquisition, right, of a 40 store competitor in the southeast. So it's going to open up a new market for them, and it's going to really give you that visibility of this 10% store growth. So I think that might be the thing which unlocks the multiple, is that Street will get a little more confidence in their store expansion plans at being 10%. Uh, so I think that could be it. So grocery outlet, the results itself were good. Nothing to complain there, but it's always sort of steady because it's sort of a franchised supermarket. It doesn't have the regular volatility of a grocer, which isn't that volatile anyway. But so grocery outlet, I think we could see that multiple. Well, the one that's kind of a bigger deal was Perigo for me. So I know people probably hate me talking about this. I hate bringing up that they had another disappointment. I went through a little bit yesterday, but on the call and with after the call, where I'm coming out is what's happened is the company is implementing some process changes at its manufacturing plant, which means they're sort of changing holistically how they approach the cleanliness of the plant. That it's not just like a new piece of equipment, it's the whole process, how they enter the factory, etc. So if you can think that very involved, it's a little time consuming. You're not producing anything for a little while. What this reminds me the most is like what Chipotle had to do after the food scare. They don't just buy lettuce from a different farmer. They had to approach it entirely differently through the entire supply chain because they don't want to mess it up again. Well, that's the same thing for Perigo. Like they can't, they didn't have a food a big infant formula problem, but the FDA has really cracked down on the industry, and that sort of triggered this new approach for them. It doesn't mean the competitors are going to respond similarly, but for them, that's what it's going to be. The new CEO is taking this approach, fixing any issues that they see, and it's not like they're just to see it. They can see in sort of the efficiencies, how much product was produced that they kept, etc. So they know there was a problem to fix, but they didn't poison any babies or anything. So this is going to cost them in Q1, and then the sort of the costs are over, and the rest of the businesses are fine. That's kind of what's lost in this. The stock got sort of slaughtered yesterday, but I'm thinking this is where you just buy it. And I know it stinks. I know it makes me look bad, or it makes the company look bad, but I think this is where you buy it, because the business hasn't been impaired. It's the private label version of infant formula, so there's no sort of problem with the brand. There's no babies poisoned. It's just a process change that costs some money for a quarter, and I think it's conservative for the rest of the year. So that's Perigo. I'm buying it. And then finally, Boston Beer, ticker SAM. The results weren't that great. It's on the short side for us. Nothing to really call out there. It's seltzers, continues to decline, but Twisted Tea is offsetting that. But at the end, you just still get a little bit of a decline. The news there is the CEO, Dave Berwick, the person who's really credited for their move into both hard tea and hard seltzer, is retiring, and they're hiring someone from Nike, which Brian could speak to. When I talked to Brian last night, he said he's a very accomplished executive, and it's a positive, but that's sort of the news on SAM, which is on our short side. And that's it.
Dog's getting smoked. I think Sam's down about 12% here. So there you go. You got some of these raging pieces of shit are getting squeezed, but that's the next part, right? I mean, don't forget that the short squeeze basket, or the most rolling short basket, which is the Goldman Sachs, their prime brokerage knows what all their short positions, right? All their clients. So of course, they publish against their clients and show, where their short positions are. And names like Big Five, BGFV on the small cap side, that's blowing up again this morning, or Sam Adams. These things have been great fundamental research shorts. You just have to time them. So again, there's a reason why, I wait and watch in real-time alerts. So today, into month end, I'll most definitely start adding some of these flaming POSs that could go to zero, BGFV being one of them. I'm sure Brian will get into that. Why would you say I'm sure he might? It just doesn't make sense, Margaret. Get with it. All right, Jenks.
Hey, Keith. Sorry, it's Howard. I got on
Go
late.
for it, Howard.
Sorry. Howard,
you're on.
Hey,
Howard,
yeah, no. I have Wi-Fi.
Game start?
What's that?
What time does the 7:45 game start?
Exactly. Well, if I had Wi-Fi, I would have probably been on time. So apologize for that. Definitely behind the process here this morning, though I did send you a email at 4:00 this morning, Keith. So about Kava. I'm sure you saw that.
Kava. We're not talking about the family, the Cavas in Thunder Bay, Ontario, great hockey family. We're talking about Kava, where my daughter and her teammates love to eat. Teenage girls love it. Kava, the ticker.
Yeah, so I just raging pieces of shit that are up this morning is beyond me. To think it's up 60% this morning on nothing. Frankly, the company is still shrinking. The retail side of their business is declining. They have no business in the restaurant industry. I still contend they have no business. So I just want to throw that out there. I've got a lot more, but I'm really behind this morning. But I heard you talking about raging pieces of shit. That would be one of them. That's up a lot this morning.
Well, one of the head traders on the sell side, he's a friend of mine, was talking to me about it the other night, and he's like, there are a lot of mechanical issues with making a market in this name. So, when you see a name, like at one point, like when I flashed it to Howard last night, I think it was up 77%. And I know it was because I wrote it down in my notebook. Because again, when you do this 6,000 trading days in a row, you get to see like rare birds once in a while, right? And so you take a picture. And again, that only happens if there's a complete, structural mess in the trading system on something like that. But this thing, every time you think that this thing's gone, Howard, they bring you back in. So up 60%, 60%. I know what to do with that. All right. All right. Thank you. That's like what Goldman would call a 500 standard deviation move or something. Jenks.
Hey, good morning, Keith. I want to hit on cruise lines and then PK. So just quickly
You're not
on,
going to start with where people can make the most money today, like win, like the button. You're not going to start with. You want to start with like PK.
no, I wasn't gonna start with PK. I was gonna start with cruise lines because people definitely, if they listen to our back and forth over the last 10 days, have definitely made money in the cruise line space. You had two big catalysts come through. So I did want to just follow up on what happened yesterday, or at least our take on it. But we could talk about Win if you want.
NCLH was up. Norwegian was up. Now we're talking that Norwegian was up like 17%, I think, yesterday.
Yeah,
What the
close to
hell?
a little bit more than that. Yeah, I mean, I think part of that big move. I mean, the stock was going to be up regardless. I mean, they had a decent print. Guidance was solid, and then importantly, the internals of the guidance were actually, so there was a really nice surprise, especially on the cost side. But I think it's more related to positioning. I mean, most people that do trade the space, like Norwegian's been the laggard, so you probably just had more people piled onto one side of the boat with that one, being short into the event. I don't think it takes a rocket scientist to figure that one out. But the takeaway that I do have from the print yesterday, and then sort of the investor materials in the conference call, which we did not have in hand when we spoke on the call, really it's just more confirmation that the industry and I guess more importantly, the narrative around the industry for much of the year to date has been wrong. So, they reiterated bookings pace continues to be strong, largely improving throughout the wave season period, this important booking period that we have once a year. Pricing on those bookings is elevated. And really, the industry's in this situation where you have incremental demand exceeding incremental supply. And so while supply growth is coming back, you still have this pent-up demand wave that is playing through and likely should for the duration of this year, and then given the elongation of the booking curve, probably set up well for next year as well. So like I said, with NCLH specifically, it's probably more tied to positioning around that name. But they did actually confirm on the cost side that basically people were thinking poor cost growth was going to be about 7 to 8%. They basically guided to under 4%. So that's a material change in the model. They're not getting as much juice because the revenue growth is going to be slower. But structurally, NCLH has been a big laggard in terms of being able to get their act together on the cost side. I actually messaged Felix because we had a couple great short calls over the years on NCLH because operations wise they've been a mess. But new CEO at the helm, looks like he's ready to affect change real quickly here. I think though, as we look ahead, they kind of pulled the big catalyst forward with putting out the guidance like they did on the cost side. So from here, I think it's more about where the interesting revenue growth stories are, which are with RCL and CCL, and then I think on those two, despite what NCLH is doing on the cost side, the margin expansion story and really the pod 1 and pod 2 stories are much stronger with RCL and CCL, at least certainly relative to expectations and just from a rate of change perspective versus the prior year. So still like those two a lot. Would continue to focus on those two names rather than NCLH, but some good things came out of NCLH yesterday. And then just to wrap things up
on that one, like just the dynamics. This is why of market structure and positioning defines like a lot of that. I mean, it was like you said, it's going to be up, but to be up almost 17.5%. I mean, that means that like lesson number one, if you ever worked for me at a hedge fund as one of my analysts, we don't do pair trading, right? We don't do running neutral. So what happened there is that most likely fundamentalists at hedge funds are long CCL and short NCLH against it. And that's what happened. So they, 5 hedge funds cover NCLH, it'll be up 10% in a hot minute. So, and it's just, we don't do pair trading. I mean, if you really have a natural pair, okay, maybe I hope they're aces, but who the hell wants a pair of 2s or 3s? I mean, most pairs suck. Just FYI.
Yeah, I mean, it's a tough way to grind out alpha. I know we have a lot of clients that do it very well, but you do get these situations where something will rip and implode right in your face when obviously probably didn't deserve to be up 18% yesterday, but that's the way of the world.
You can do something very well most of the time, but if you blow up, it doesn't matter what you did well most of the time. So that's why I don't do that. I take out the blow up factor risk. Anyway,
I like that. Just on PK, so we're sort of rounding out the hotel REIT earnings season. So Q4 was already in the bag because they had pre-announced in late January. Guidance commentary. So guidance for the Q1 does imply accelerating RevPAR growth. They do face easier comps than the industry. So a little bit different dynamic with PK in that the Q1 is implied to accelerate to 7% year over year from Q4's 4%. So decent acceleration. As like I said, they face easier comps. But beyond the Q1, if we look at the guidance for the full year, it actually implies RevPAR deceleration back towards 4 to 4.5% growth. And actually, if you sort of take historical seasonality for their portfolio and look at Q2 through Q4, it looks like growth is going to go peak at around 7% and slow through balance of the year to 3 to 3.5%. They're facing really tough comps in some of their leisure markets, in particular Hawaii, and banking on this return of the Japanese traveler to come back to that market as the domestic business starts to slow, as people go elsewhere and travel to different parts of the country and then and abroad. We're just not seeing that catalyst as it relates to PK. But I think more importantly on the EBITDA side, so their guidance at the midpoint was exactly in line with where consensus had it. And mind you, numbers have drifted lower through the year. But really, it's on the back of incremental cost growth is likely to erode a lot of the progress that they're guiding to on the RevPAR side, especially in the first half of the year. So for the year ahead, we have with PK, you got slowing RevPAR growth, slowing total revenue growth, elevated cost growth, and thus they're guiding to margin degradation. And they tend to guide a little bit more optimistically than peers. So I just think, if you don't want to be short it, that's fine. I mean, I think, the momentum's been there on just the hotel space broadly, but from here, there's just way better hotel names to own. If you look at a name like RHP, which is REIT focused, is a REIT, or HLT, or on the cruise side, like I said, RCL, CCL, or in Macau and Vegas. And I'll close it out here with that. More Vegas exposed would be MGM, but Wynn capturing both the Macau exposure and China beta plus the Vegas exposure that they still do have. And numbers are way too low on Vegas. I was actually working through that yesterday with a client. So a lot of other options out there. Why buy the slowing growth stories that don't have margin expansion? Buy the opposite of those factors with the names that I just gave you. And that's it for me.
One being the one I started with. Wynn has exposure to Las Vegas. Okay. Good. Hotels, if you ask me, the signal's bullish trade and trend, and that's because we have GDP reaccelerating to quad 2 in May and through the back half of the year. So that is definitely going to be a bullish factor that hasn't been one for hotels for a while. And then, markets sniff that out very, very well. Because, these were great shorts for a while. They're just, I don't think they are now. Or the signal doesn't. I have no opinion.
Yeah, working through that, wrestling with that right now, because you do have, the cost side of things is going to be another big headwind, but and you just haven't seen the acceleration, the pickup. I think you have in certain names, right, on the hotel side, but I'm trying to figure out if the bull story on RevPAR is actually going to come to fruition, especially now that they've in effect guided to it, and now it's definitely in numbers. But it's offset by the fact that they're going to have another bad cost year. So, couple things to sort of work through pros and cons with. But like I said, there's still names on the hotel side that we do like. But
macro, you wouldn't see the acceleration. These 2 months, you're seeing deceleration.
Right.
In macro.
Right.
You're going to see it in the future is the point. And like yesterday's durable goods number, it was down 510 basis points. Durable goods is a major factor in the US GDP calculation. Again, we thought numbers would slow against tough January and February comps, top down macro. And we just had two of the worst numbers that are big heavyweights in the GDP model, being retail sales at 0.6%. Durable goods was negative 0.6%, down 510 basis points. In January, that's the lowest level of durable goods in 42 months. And it didn't matter. Okay. So again, understand that we understand and keep going on here. It's on to the next play. The market's discounting the future, not what happened yesterday. Of course, yesterday's easy to understand. All right, McGough.
Yeah, good morning, Keith. I love when you talk about quad 2 coming down the pike. That's where I live. That's when retail trades well, and that's when my longs just explode. But we're not there yet. And you mentioned Big Five, BGFV. This is a name we shorted at 20. The stock is now at 5. And it is going to zero. I've said this many times on the call. I hope people have been paying attention. But this is one where even when we're in quad two and retail rips, this is one that's still going away. So if you are lucky enough to have shorted Big Five when it was easy to borrow, God bless you. Just hold on to it, because that company is going to be a bagel. Next one I want to hit on is I'm going to speed date here through a bunch of tickers in very typical McGough style. But
I'll only interrupt you once, but to be clear, and please don't cancel. I am a Catholic. Brian McGough is the only person in the world this morning blessing people to get a Boro. Go on.
Next one is Warby Parker, WRBY. We co-covered this one with Tom. He covers EYE, which is one of Warby's competitors. This is a company that's on our long bias list. And I'm being very patient on this one. This is a really good tail long, but I'm waiting for my timing on this one. I'm waiting for the inflection in the pods. I'm waiting for the signal in order to get more bullish. The company missed slightly on EBITDA, but that's about where the bad news ends. Pods kind of leveled off a little bit. They've been in a decline for a couple of years. The problem with Warby Parker over the course of a couple of years, and why we had been shorted for so long, and we pivoted on this one a couple of months ago, is that it was opening stores in very expensive locations, like on Newbury Street in Boston and on Fifth Avenue, like really expensive rents, and it sells a value product. You could buy a pair of eyeglasses there for $95. So it hasn't been opening stores where the consumer shops. Well, now it's got 225 stores. It's opening its next tranche of stores over the upcoming 2 to 3 years. I know that's an eternity. I get it. But now it's opening in what we call B locations. So it opened up first in A locations, your really expensive spots. And now it's going into more affordable real estate, gets better rent deals, and lo and behold, just happens to be opening stores where the customer shops. So you can see a really good path here over the course of a multi-year time period. The stock is now down in the teens. Again, I'm going to be patient on this one. I'm going to wait for our research call to evolve. I'm going to wait for the pods to turn. Even if I'm a little late on this one, I'll be patient, because once it starts going, it's going to go big. So that's Warby Parker, WRBY, long bias.
I'm surprised that you're not going to just wait for the signal first. I'm going to front run you on this one too, buddy.
All right, knock yourself out, bud.
I did on Beyond. I did on Carter's. Actually, Carter's at the low end of the range. I did, and then I didn't. So there's one. We're waiting. Definitely paid off.
Yep. I don't mind being front run. Not one bit. One name I want to call out this morning is IPAR, Interparfums, which is the biggest third-party manufacturer of fragrances in the world. In the world of beauty, the one category that has absolutely killed it over the past 3 years is fragrances. We've seen price increases every single year, 10 to 20% per year. I've been short this stock, a best idea short, and I've been wrong. Well, the company just put up their quarter this morning and it missed. So it finally missed. This company was smoking numbers every quarter by 30%. And they just put up a miss, which is a big win. The stock's not down that much. It's kind of illiquid. I think a lot of people are afraid to short this because it trades like a staple. We're still in an environment now where Daniel's names, staples, trade well. That won't be the case once we're in quad two. One important point, pod one here, revenue decelerated from plus 31 to plus 6. That is a colossal deceleration in pod one and something you can't ignore. So IPAR is one where if it went against me again this quarter, I would probably have punted it, but I'm now going to stick with it. It's just a very expensive stock with decelerating pods, pod 1 and pod 2. They tend to go in hand in hand in retail. When you get the sales coming down, you get the margins that delever and cash flow comes down. So that is IPAR, IPAR, best idea short. Next one is Urban Outfitters, URBN. I'm kicking myself on this one because I had been shorted for about 9 months, along with my 75 other shorts, and it just didn't play out. I got half of the model right, which is Urban Outfitters, but Anthropology, which is the other half of its cash flow, had just been killing it. This company, so I booted it this past weekend. I took it off my list. I didn't have a variant edge headed in to this quarter. I don't always have that on a given quarter. There's times I don't want it because I don't want information I shouldn't have. I want to play the game fair and square. But the company did come out and miss. It wasn't an egregious miss, but it was a miss nonetheless. So just want to be transparent, call myself out. I took this off just ahead of a miss, bad call. It's one where we'll definitely revisit that. If there's more pod 1, pod 2 downside, I'll get back on it if the signal agrees, but I'm inclined to think the answer there is no. Next ticker is Revolve, RVLV. This is a name that is one of our best shorts of all time. We've had a couple of doozies, but this one we shorted at 70. It's now at 17. We covered this name ahead of the quarter this past weekend, and the company came out and beat and had a pod 1 acceleration. So, and I believe, I know we talked about a week ago, Keith, and you indicated that signal strength was looking good. So this is a good example where the signal sniffed it out in advance. So the stock's trading up a little bit here this morning. This is one I'm inclined to go long. I mean, this name trades. It's all over the place. There's no reason it can't go back to 70 again. If I have to be quote unquote late and jump on it at 22, if it rallies over the course of a couple of days, I'm willing to do that. I want to make sure I de-risk my downside here and ensure that this quarter was not a head fake. But if you want to front run me, you, Keith, or you, the viewer, go ahead, knock yourself out, RVLV. One of the big factors here on pod 2 cash flow and also pod 1 is that the company's return rate, like you buy product there and then like you wear it and then you return it, like it's almost criminal, is 60%, 60. It usually trends at about 50. If we and now we're about to comp the comp on this elevated return rate. So if that comes back down closer to 50, you see an acceleration across the board. Pod 1 accelerates, pod 2 accelerates, and your working capital gets a hell of a lot better. So pod 3 looks good as well. And last but not least, I want to touch on TJX, which is a signal strength stock too. It has been, this is one of those names where it's not like, it won't make you rich, but it's just going to grind higher. We went long this name at $60. It's now at 100. And that was when the rest of retail was absolutely melting down. It's a very defensive stock. The company comped the comp. Expectations were for mid-teens EPS growth on top of mid-teens EPS growth last quarter. So the top quarter this year with EPS growth comped against the top quarter last year EPS growth. And the comps get easier as this year moves forward. So I think the punchline on TJX is people are going to be looking at $5.50 in earnings power. This name will get a 25 multiple on that easily. You get to $125, $135 stock. It's now at $100. Will that make you rich like a name like Beyond will, which I think will be a 3-bagger? No, it won't. But it's kind of like a Costco type name. It's just going to continue to grind higher over time. So we're sticking with that one. And that's all I got for you this morning, Keith.
Making people rich, eh, McGough? I tell you. And we have a lot of different kinds of subscribers. But But if your goal is through a stock pick to become rich, that's not what Brian meant. He meant that it has more upside, a lot more upside than TJX from here. But if you want to maintain your hard-earned capital, let's start with that, and then compound and continue to be rich. You should do all the above and have a portfolio of these types of names. If it has a higher beta, like Beyond, you'd have a smaller position than you can have in TJX because it has a lower beta. So in other words, if your max position in a single stock is 4%, then you'd have 4.5% beta adjusted in TJX, and you might have 2.5 to 3 in Beyond. Now, if you're a big swinger and big hitter and you go with a 25% position, like some people did in Playboy, you'll hate Brian for life at some point, and that's on you. Right? So that's how not to be rich sometimes. So be careful. Be careful. There's a process to this. Process. We're going to keep working the bag here. We got these signal strength longs. This is going to be a really good year. We're going to evolve here alongside everybody to make sure that they're getting that alpha, that purity of the alpha, that pure Canadian maple syrup. All right. Tom.
Yeah, so Life Stance, so there's a couple of things this morning. Life Stance, Patterson, PDCO, UHS, and a couple other things on earnings, but I'll just hit on those quickly. So Life Stance had this short report, Hindenburg, a couple of weeks ago, I guess. And when I read through it, a lot of the issues that were discussed were essentially, exactly the same as what we had uncovered when we were short the stock. And the whole concept here is that you've got a guy who ran some of the biggest and I guess a changing reputation, but at least at the time, reputable managed care companies around Ken Burdick. And whatever, this was a unbelievably poorly run company that's now getting better run with a huge demand curve, right? So if they fix the problem, there's a huge opportunity in the way the model scales in terms of how the way I've built it is essentially on a per clinician basis. So as long as they're hiring, everything's good. And what they put up for the quarter was, essentially a little bit better than my higher than average estimate. So they're adding clinicians who bill hours. And then the other metric that you get is, well, how efficient are those clinicians? I was a little concerned that the December quarter, after being weak in September, that maybe those hours weren't going to be as good, that they didn't fill as many slots, but it was up 25 bips sequentially, which is really good. And then their guidance for Q1 looks very solid and EBITDA positive and free cash flow positive. And so this is a broken story that's turning with a huge upside opportunity. So I'm really curious to see how it acts today. It calls in a few minutes. I'll be listening to that. But you've got this kind of incremental interest because Hindenburg had the short report out, which we covered on a healthcare show a couple of weeks ago. And then on Patterson, which was the exchange that you and I had over the weekend, I went through the healthcare macro data set. I'm using this new tool that I built, essentially pointed at weakness in dental and vet. They got incremental weakness on equipment. They got incremental weakness in animal health. The guidance is poor, so they're guiding down again after they missed and sort of included the miss of their last quarter in the full year. They're ending April. They said, the back half looks okay. Like we're only taking it down for this. So now here's an incremental, right? Like another incremental 5 cents. Stocks trading lower, but the point here is that the miss is marginal. Right, this is not like a falling out of bed setup, but it is on a quad factor basis and on your signal, very much a short, right? And here we have marginal weakness fundamentally, sort of pushing the stock down and back into the mid-20s, and I think lower. From a sensitivity analysis, you could get 22 is not an unreasonable price, and that's nice work for a couple of days, right? I'm pretty pleased with that. Pretty pleased with that result, and then. I'll let you go to Emily on this biotech.
That's typical Tobin commentary. I'm very pleased with that. I mean, it's like in a market that factor exposures like broadening, squeezes, moonings are going vertical on short sellers. I mean, any short that works, that's the equivalent in hockey to getting a couple goals a game from your fourth line. I mean, from the shorts. I mean, that's very good. It's called alpha. So well done on that, and well done on the UHS squeeze too on the long side.
Yeah, that's what I was just going to get to. I'm not going to talk that much about that just because this has always been a story about even these guys can win in this kind of environment. So, and here they are, right? And I had meetings last year where people were just like, well, don't you know? Don't you know this? Don't you know that? And this, that, and the other things. Like, yeah, I know. These guys are Goombas, and they have a tough time getting out of the working their way out of the earnings paper bag. And in this case, it's been a couple of quarters, and here's some good upside and good guidance. And this is really it's a very simple investment thesis. Labor is normalizing, more labor, more patience, more money, more margin, right? Like it's not that hard. And everybody's going to stand around and say, oh, look how smart we are. Look how good our business model is. Look how great operators we are. And it's like, you don't know. Like that outside the four walls, things look pretty good and you're just benefiting. So there's that. But yeah, but life stance, put that in your pipe and smoke it. That's the most interesting thing I got going on today.
Well, the UHS is like a history of our lives in the hedge fund business. It's like, don't you know? I mean, yeah, don't you know that it was signaling bullish trade and trend into the print, you idiot? I mean,
the super strong quad factor score, super strong.
But you know, if Captain Fundamental that's retiring at hedge fund ABC since the pandemic, they don't speak our language on that, and they hate it, right? Because it retired them. But believe me, I got hired at Carlyle because I was really good at picking stocks. Tom can audit my book within the book at Dawson. You know, one year I was up 81%. Okay, I didn't just like come out of nowhere. I mean, well, I did out of Thunder Bay, Ontario, parts unknown, but I could pick stocks. All right. And could I tell you a story about stocks if I pick stocks, right? But then I realized that game was changing. So I changed. So think about it. I'm not calling you an idiot if you're the person at home now running a family office because you can't run a hedge fund. But I am calling you an idiot because you're way smarter than me, but you're dumber because you won't change what you do, right? That's what the definition of dumb. In Thunder Bay, Ontario, if you step in a pile of bear shit, and then the next day you walk to the same place and step in it again, I don't care what your IQ is. You're fucking dumb, right? You gotta get to a place where you change. Okay, Emily, that's a little aggressive, but you know, it's a thing in Thunder Bay. You could step in that stuff.
Oh my God, that was a great lead-in. So the XBI, as you pointed out last night, closed over 100, mostly on the strength of Viking Therapeutics. Squeeze, that was a nice squeeze right there.
Oh my Lord. So here I'm a really smart hedge fund guy. I'm short Viking and I'm long Novo and Lilly because I do long short neutral. Well, that's nice. I mean, Novo and Lilly went down yesterday and Viking was up 122% on the day.
Yeah, and
that doesn't happen unless the fundamentalists are on the wrong side of the trade. I mean, that's crazy move.
Right. Right. I mean, and their readout was pretty positive on, you know, efficacy and safety and tolerability, and all the things you would like to see that you aren't seeing in a lot of GLP-1 and other anti-obesity medicines. So it was a good result, and they deserve accolades for that. That doesn't mean that the problems of the biotech sector and XBI are over. You know, a lot of what's happened has happened because you know, a lot of the performance this year has been because of the expectation as far as the interest rate environment goes, because the problems that remain for the sector are largely funding, and cost of capital, of course, is one of those problems, and that, you know, the funding that occurs from the private sector, from the large pharmaceutical companies, that matters. But its other big problem is it gets a ton of money from the federal government, you know. And if you look at the employment, you chart employment next to NIH funding, they got the same curve. And that funding is stressed, shall we say, given everything that's going on in Washington with respect to the budget, and then you have the political environment with respect to, you know, international cooperation that is also putting a damper on it. So you know, kudos to Viking, but let's not get too carried away here. I think there's also still a decent amount of M&A to go, because there's some good product out there, and these big biotech companies, big biopharma, that's all they got right now is to buy the pipeline that is going to produce the best results. So And I'm sure Viking gets taken out for that reason, as long as their data holds up. But do you have any questions on that? Because I have one more thing.
No, we got to keep rolling. But again, it's a very good example. So far this morning, I mean, we're only not even at 8:30, and there's some very good examples of the flow of the machine, the behavioral components, hedge funds covering things that you never hear on old wall TV because none of them ever analyzed the company for real, never mind traded it within a hedge fund book. So lots going on. Biotech squarely the example of that. But what else you got?
Just one note, Wall Street Journal reported yesterday that United Health Group was under investigation for antitrust practices by the Federal Trade Commission. I'm sorry, by the Department of Justice. This, and Paul, I'm sure will follow this, but this is a concern I've had about this name for a while. Specifically, are they acquiring doc practices by making life so miserable for the doctors with respect to administrative burden that they see only one way out, and that is to be acquired by Optum, the UNH group. And there's some other issues I think that might be there, but we'll see how it shapes up. But it is the risk for United Health Group, and that's it.
Yep. Okay. Steinbomber, you and I are going to revive the stock picking. We're in a revival. If people can't tell, phase 2 of Hedgeye started in July of last year. We have a bunch of new products that are going to perpetuate this success, and we're going to fail a lot too. So get ready for those. It's actually the quote of the day, isn't it, Steiner, from Bill Walsh?
Yeah. Well, I don't think there's a more humbling industry than ours. It's usually when you feel awfully confident that the market tends to give you an education.
It's a great. It's one of the. I said yesterday, my dream is to expose all the frauds like more publicly through this channel. But what a great opportunity, right? To educate people through all the mistakes that people make in this business, as opposed to watching the poppycock bullshit on CNBC where everybody's winning every single day. I mean, you're not going to learn the game that way. You're going to learn the game by nobody's made more public mistakes as a hedge fund manager that has showed every position than me in the history of the industry by a lot. Okay. So we're going to learn a lot about these things. And Steiner and I will have some good stock picks, some bad stock picks. And it's the bad ones where we learn, the good ones we expected to win.
Yeah, I would say, just obviously because it's moving so much, I would just say, it's interesting on Bitcoin. Basically, what you've got going on here in the short term is this sort of, I guess you could sort of describe it as the machine. It's this reflexive loop where everybody is chattering about these daily inflows into these spot ETFs, which the numbers, they get reported daily. And so the numbers are actually very significant. I mean, you're talking about north of $500 million a day net flowing into, these various spot ETFs, even adjusting for grayscale outflows. And if you think about the creation rate of Bitcoin, which is 6.25 new blocks or new Bitcoin per block mined, which works out to 900 new coins a day, which at 50,000 is roughly 45 million in new creation a day, and you've got north of 500 million in net inflow. That's how you sort of get there. And then what ends up becoming this reflexive loop is that the market looks at those inflows, does the math on that creation rate, and then sort of keeps dogpiling. And so it becomes this sort of short-term engine that keeps feeding itself. At least that's kind of the narrative overlay. So anyway, anybody kind of curious as to why it's been sort of moving the way it's been moving in the last, couple of days, couple of weeks, that's sort of at the heart of it. But that wasn't really my plan to focus on that today. I was going to talk instead about a couple earnings reports we got last night, one of which is a small cap in the housing sector, Redfin, ticker RDFN. Redfin has been a long-term short idea that I've had on, and it really gets to sort of the heart of, what is this company actually worth over a long period of time. And the root problem there is that they're relatively small in terms of their market share, and there's a lot of premium built in to the valuation of the company around expectations that they'll gain a lot of share, like 7x their share over time, but instead their share keeps shrinking. So this quarter they reported that their market share dropped to 72 basis points. That's down 6 basis points quarter over quarter, and in the last 18 months they've dropped about 11 basis points of share. They've fallen from 83 to 72 basis points of market share. The problem is that we know from public comps, companies like Remax, companies like House Anywhere, which is the old Realogy, that a point of market share isn't worth very much. Those companies are facing a different set of challenges now vis-a-vis this big lawsuit over whether there's basically antitrust dynamics within the NAR itself. These companies have been named in numerous class action lawsuits, but they are trading at below at or below $50 million per point of market share, and Redfin is trading at $800 million with less than a point of market share. So therein lies sort of the basic fundamental challenge, is how do they overcome that? And then I would say the quarter itself wasn't great. They missed, and then they issued guidance that was a disappointment as well. Obviously, the numbers we got this morning on MBA were down. The purchase app series down 4.5% week over week, but zooming out a little bit, down about 15% from December levels. That, of course, is a reflection of the move in the 30-year fixed rate mortgage, up from 6.6 to 6.9. Albeit still down from the peak of 7.8 in October, but what matters is what's happened more recently, and that's an upward move of 30 basis points. The refi index has also slowed about 7.5% week over week, and down about 10% from December levels. So bigger picture here with Redfin is that eventually when rates do come down, obviously the existing home market will benefit. Volumes are likely to pick up because you will unlock supply that's basically tucked away on the sidelines because nobody wants to go from a 3% or 4% mortgage to a 6 or 7% mortgage. That will unlock itself over time. But so long as the yield trend at the long end is bullish, which it remains, that is going to be an event for another day. So no change still in my fundamental bearish view there on Redfin. And then finally on the Canadian bank side, we continue to get numbers there. Just looking at Royal Bank, earnings are down year over year, as we saw with the other banks yesterday, down about 6%. They did come in a few cents ahead of expectations on their adjusted number. Bigger picture, provisions came in above expectations, as did operating expenses. The credit deterioration that's been sort of the cornerstone of our bearish Canadian bank and real estate view for quite a while continues. The country at large is largely in a balance sheet recession, and that the root of that is really the fact that the Canadian housing finance structure is just fundamentally different than that of the US. The US is long-term fixed predominantly. In Canada, it's essentially intermediate term fixed. Most Canadian mortgages have a fixed term anywhere from 1 to 5 years. And so each day that goes by, you basically sort of capture, if you will, an incremental, small but incremental percentage of people who are coming up for these resets and renewals. And so on the margin, that continues to put pressure there. And our inflation outlook in Canada remains in the high 2s, low 3s looking ahead. So that too is going to keep a box around the Bank of Canada and constrain their ability to cut rates. So ultimately, that's going to keep the pressure on for longer. So it's still no change in our bearish view there on Canadian banks. That's it.
Good, lots there. Again, one of the main goals of the call is to, again, be the truth tellers about names where the CNBCs of the world, Bloombergs, will never reveal the Redfins. Are you kidding me? They called it a technology company. I mean, these companies are pump and dump schemes to a large degree, their narratives. and their job and the executives at Rich selling you stock. Okay, so never forget that, ever. All right, and I get it. If you can't afford the call and you have to watch something, I get that. I do. But that doesn't mean that it's the right thing to be paying attention to in terms of believing. All right. Thanks. No Rob today, no Jay today, so I caught up on time a little bit. I don't see Freebird either. Is it just you, Zegers? Friedman or Zegers, you guys on?
Yeah, Billy's coming. He he thought he had a couple more minutes there. He just run into log in the studio there.
Hey Keith, sorry, I didn't realize there was no Jay, no Rob today. I was a little had to move over here to the studio, but
well, all you analysts have to realize that it's 8:35, right? So we have a new energy analyst joining us. You guys are going to be very mindful when the clock's running out, you know, that there's still other people after you. So we got to be on. We're going to have a meeting about this, and that just obviously has nothing to do with you today, but yeah, we have to be like, I'll run the call. I know where the time is. I know where the clock is, but at 8:35, we only really have 10 minutes left, right? So you guys have anything or?
Yeah, we had TKL out last night. We have a note coming out later this morning. The stock was down off of the print because they gave a pretty weak guide for full year 2024 with revenue and EBITDA implying a revenue slowdown for the full year 2024 per 23 and EBITDA implying a little bit of margin compression. We had to wait an hour until a call started to get clarity on that guide. And when that clarity came out, it turns out that they excluded an entire quarter's worth of revenue from WWE Raw's distribution deal because of a nuance with the deal timing wise, where the WWE deal right now on USA Network with Comcast ends in September 30th. And the new deal with Netflix does not start until January 1st, 2025. So there's an entire quarter where they still have to sign a temporary, bridge deal, if you will, for WWE Raw. And they, in their guide, they didn't want to include or assume any numbers for that. Going back to the numbers, the run rate revenue for that is about $75 million. And in our note that we're going to send out this morning, we clarify that if you add back that $75 million, along with a one-time $20 million adjustment for some nuances in the UFC's fight calendar for 2024, the revenue and adjusted EBITDA actually looks much better. So all that will come out in the note. I'll leave it at that for timing, but WWE or TKO was better than the stock price reaction, and we have more thoughts coming soon.
Good. That's tight, man. You get right in the seat. That's why we hire. People are tough on us because we hire hockey players, but give us a break. I mean, look, the guy just popped in the seat there and just delivered the wood. I mean, that was awesome. And of all that, I've been doing this for a quarter century now, which is really kind of sad and embarrassing, Billy, like aging myself. We were talking about the hair thing yesterday in the office. I mean, I'm just getting old. But the word EBITDA, like I've heard many pronunciations of that. You and I share the hockey pronunciation of that. Okay. So for those of you that say EBITDA, that personally annoys me, but there are a lot of different EBITDA. Some people like roll it. So anyway, it's just something completely useless, by the way. Balchi, how do you say it? How do you say the cash flow acronym?
It's EBITDA.
EBITDA. Yeah, is that how a guy from Chicago says it? EBITDA?
I guess so. I guess that's just the Midwest accent in me.
I've heard EBITDA. Okay, EBITDA. I like
EBITDA.
That. That's okay. EBITDA.
All right. So on the software front, though, Workday reported earnings earlier this week, and this is a name that we started to become more positive on after doing the work for ServiceNow. And it's a name that dominates the human capital management space and software. And so in the earnings report for Q4, revenues grew 16.7% year over year, which beat both the street and guidance. The company guidance indicated that revenues will reaccelerate to 17.1% year over year. Subscription revenues grew 17.7% year over year, which continues to decelerate, but professional services revenue reaccelerated to 7.4% year over year, which compares to 4.7% in the previous quarter. Billings grew 16.2% year over year, which was slightly below street estimates. The company did buy back over $400 million of stock for the year. And it wouldn't be a software earnings report if AI wasn't mentioned. And they announced that they're acquiring Hired Score, which is an AI-powered talent software company. The stock was down slightly on the report, but there were no major red flags, and definitely a name that we're going to do some more work on here to finish out the quarter.
Positively inclined, it sounds like.
Yes.
Yeah, I mean, it's a signal on that's bullish, by the way. We'll be in touch on all these names that these guys are rolling it out. And again, it takes no work to be drawdown Josh Brown commenting on software, cloud, security, no work, right? Just big brains, right? For us, we have to build the models. Okay, we have to do the real work, and there's a entirely different league to be in when you're doing that. Doesn't mean you're going to be more right. Doesn't mean you're going to be more wrong, but it's a level of quality assurance in the research that we take pride in, as do the world's greatest investors that earn many of your fees. All right, Felix.
Let me mention Coupon. The ticker is CPNG. It's a South Korean e-commerce giant that I cover. It's on my watch list. It beat earnings estimates last night on revenues and EBITDA, and saw decent gains on customer growth and per customer spend. I pay attention to this name because it's being attacked by Chinese competitors like Temu and AliExpress. The founder and CEO, Bum Kim, kind of disregarded the question when asked on the conference call last night on Chinese competition. Instead, he points to Coupon only capturing a single-digit share of the so-called $560 billion TAM opportunity in the retail market in Korea for the next 2 years. But there's no doubt in my mind that the Chinese guys are making traction in Korea. It's only a matter of time whether they feel the impact or not. But the bigger question is the market big enough to accommodate everyone there in Korea? Keeping my eye on this one. That's it for me.
Is that listed in the US, that ticker, or is that the South Korean exchange ticker?
It's listed in the US, CPNG.
Yeah. I don't know if you saw yesterday, but we added to our relatively new, being long small caps, growth, not value. IWO was a great position yesterday in macro. We recently added South Korea, Felix, because we have them going into quad 1 and 2 for the next year. So South Korean longs, my ears perk up a little bit. I hear you better when I see that. So then I just need the ticker, and then if it says bullish trade and trend, I'm really listening. Right? I'm listening. There's a difference between listening and implementing. Okay, implementing ideas that have all the above: the top-down macro setup, long South Korea, long trade trend signal, long analyst view. That is good. Okay. Those are the highest quality longs right there. And again, it's not about conviction. It's about taking all the components that would move an equity in this day and age of the machine that matter. All right. Paul, I think you gassed like most of your time for the week yesterday, by the way.
Yeah. Oh, and I like the Bill Walsh quote this morning. That's a good one. That's, he had a really important strategy, which was in every game to try to score more points than the other team. Very core strategy. And unfortunately, Kyle Shanahan, the current coach, doesn't necessarily follow that strategy. Maybe next season, we'll see. The news flowed this morning is that they're having last rites meetings at the Justice Department. That's when whether it's a merger that's going to be challenged or whether it's a monopolization case that's going to come, the company executives come in and they talk to the DOJ and say, is there any way to avoid a lawsuit? And they apparently have had that meeting with Apple in the last week. That's what the reporting is. It's been rumored for a while that they'll bring an antitrust case, monopolization case against Apple. And if they do it, just and basically it would be that the way they operate the ecosystem, the software, the hardware, it makes it difficult for others to get onto the platform and offer innovative services on that platform. It's not that different from the whole Microsoft case back in the 90s. But nonetheless, if this happens, remember that this is the kind of thing that to litigate, you're probably talking about going to trial if they do it like in 2027. And the next administration would be the one that takes the baton and pursues the case. And you also have Digital Markets Act enforcement and all this kind of stuff happening in Europe. So it'd be interesting to see how everything evolves. But it's one of these things where if it happens, it's a catalyst and it makes a lot of news. If it happens, they're talking about before the end of March, if they file. But these things tend to, take a long time to play out, and a lot of things happening in between. As it is, like the Amazon case, I think they're talking late 2026 on that one, and the FTC filed that just a few months ago. So, but watch for that. We may have some news flow on that in the next few weeks. So that's it.
Good, tight, just like Bill Walsh's Routes.
Yeah.
Man, one of the best books I've ever read, even though I'm talking to a Steelers fan. Good morning, JT.
Good morning, Keith. Yeah, so I'll try to make this quick because I feel like it's what is February 2nd, Groundhog Day. I feel like we're already at the end of February. It's still Groundhog Day. There's this talk of an intense meeting at the White. I don't know what would be so intense about a meeting at the White House yesterday because it's the same outcome. They're out of this. There's still no agreement. They're moving toward an agreement. I do think some of the pressure is off right now, at least on the government spending side, in the short term. So once again, we have a deadline on Friday and Saturday, and I think we'll probably push that to March. I think the thought is to push that to March 8th, those first 4 bills, and then take the other 8 bills. This is so confusing, man. And push the other 8 to March 22nd. And so again, just sort of moving the goalposts once again on this thing and trying to finally get to, this is all about what we call policy riders. The numbers are set, but they're trying to add on, both sides are trying to add on policy riders, which really aren't germane to the underlying appropriations bills. And at some point, once both sides are going to have to give up that fight and just shake hands and move on and be done with this. Again, we're 5 months into it. So it looks as if we're not quite moving to a shutdown right now. I'd say the chances are lessened over the past 24 hours. We're still not there. They still have 2 days to do this. And again, as I said yesterday, Johnson holds all the cards. Where they don't have an agreement yet is on the foreign aid supplemental. Johnson was much more committal about trying to avoid a government shutdown. Where he wasn't committal was in moving forward the Ukraine, Taiwan, Israel bill. It wants to do something on the border before they can do that. So I think a lot of this is going to play out here today. Now that both houses are back, and tomorrow, and I'll have a better feel probably midday tomorrow of where this is headed.
Yeah, there should be, at least on the topic of the deficit itself. I mean, I get that your point is it's kicking of the can, and that there should be some intensity associated with that. I mean, somebody in America put up your hand, get your congressman or any of these yo-yos to when they do have a meeting, get intense about it. I mean, the deficit, JT, is going from 1.7 trillion to $2 trillion.
Yeah,
right?
I mean, it should be, I don't know if I said this on the call before, but I was talking to some Hill staffers about this, but this needs to be a part of every congressional campaign. So if you're going to be doing these town hall meetings, if you're going to be debating your opponent, whether it's a House seat or a Senate seat, or God forbid, the presidential, make sure the debt and deficit is one of the questions. How do you intend to address the debt and the deficit? It should be part of any questioning throughout the campaign season from here on in, and see how they respond. At one point in time, 10, 15, 20 years ago, they used to sign, and I thought they were goofy, but they used to have these pledges about, there was a no new tax pledge, and there's another one, but there should be a pledge for all intents and purposes forced on candidates, say that, one of the things we will talk about, one of the things we will address in the 119th Congress in 2025 is the debt and the deficit. Press them at town hall meetings, press them at in the grocery store. One of the Congress people I worked for would go to the grocery store. That's how she would gauge sentiment in her district. and corner your member of Congress in the grocery store and buttonhole them and ask them what they're going to do about the debt and deficit. It should be a part of how we're engaging our elected officials every time we get in front of them.
In the grocery store, you see the inflation. Milk prices are up 13% in the last month. In the grocery store, the thing that creates the inflation is debt and deficit spending. We've done extensive work on that. Okay. But the problem is, and the sad and pathetic reality is that this election's not going to be about those things or the future or America. It's all about individuals, their insecurities, their hate for the other team or the other person, the other party. It's not about that. Both parties have built these deficits and debts. They're both complicit. There's no solution. It's the fourth turning. It's what we thought it was. So on to the next play. Good luck, by the way, to the Brunswick boys today in the Elite Eight of prep school hockey. Will be playing a home game, playoff game, knockout game against Salisbury.